In this notebook, I have the explanation of why Palantir is going to make a lot of people, myself included, rich. Now look, there's no guarantees in life except death and taxes. We're all going to die. We're all going to pay taxes. But in this notebook, I have the explanation of why I think Palantir is the only stock right now in the market to give me a Tesla-like return over the next 5 to 10 years. Now, about 10 years ago, a gentleman you all know by the name of Peter Thiel wrote a book. That book is called 0 to 1. I highly recommend you go and read that book. Now, in that book, what he was saying essentially is that he's going to build a company that's going to become a monopoly in an industry that does not yet exist by solving a problem that most clients don't even know they have yet. Now, that sounded like crazy talk, but now in 2023, we can see the dude was right. Now, Peter Thiel, in case you don't know the guy, he was the co-founder of Palantir, but he's still also the co-founder of PayPal and part of the PayPal mafia along with Elon Musk and bunch. Now, Peter Thiel is no idiot. We know that. And Peter Thiel said 10 years ago something very interesting. He essentially opened up his cards. Now, on the poker table, who shows his cards? Only somebody who knows that he won 100%, which I think what Peter Thiel knew in 2014. Now in 2023, everybody knows about Palantir. They're nearing $2 billion in revenues, massive net dollar retention, lots of hype. Everybody's talking about Palantir, but the question is what to do. A lot of you are wondering right now how to invest in Palantir without taking all this massive extra risk, because nobody's excited to buy Palantir after a 127% spike in the share price of the past few months. It's just too expensive. It's too scary. Who wants to buy into a parabolic spike? Nobody. And I'm here to tell you there's a way. If you stay till the end of this video, I'm not only going to show you why this is a $1 trillion company, I'm going to show you how I'm increasing my position in Palantir without taking all this extra risk of buying into a FOMO cycle. There is a way to do it. Before we do that, I want to give a huge shout out to today's sponsor, Tendies. I've been working with Tendies for months. They are a free platform, no premiums, no paid subscriptions. You get a free newsletter with some of the best information about the stock market, the economy. You get an options flow, and you get the best options calculator in the market. The link is below. Go get it right now. It's a must-have for any investor, especially in times like these. Tell them Tom sent you and thank me later. Now, moving on to Palantir. Now, let's go through my notebook right here. What happened with Palantir? We have to back it up a little bit, right? So the stock is up 80%, at least since the latest earnings, but it's up 127% year to date. What happened? Well, look, Palantir always had a strong balance sheet. They had nice growth, but the one item they missed, just to be great, is profitability. Now, that catalyst finally arrived a quarter ago, but this quarter, it happened the second time. So after Palantir hit profitability twice in a row, a lot of fundamental-based investors basically said, well, look, if this company has a terrific balance sheet and growth and potential and it's profitable, why not? At $7 a share, boom, they started buying. Now, when that happened, the perfect storm was brewing outside of Palantir, which was the AI hype. AI was becoming a thing. People started realizing, well, AI is the future, which it is, but there's a lot of caveats to that as well. But then investors started realizing, well, wait. Isn't Palantir an AI play? Of course they are, dummy. They've been doing AI for 20 years. Foundry, Gotham, Apollo, they're all AI-based data analytics system. And they've been doing it for 20 years. So all of a sudden, people started buying into Palantir. And then people started saying, well, look, it might have an S&P 500 inclusion because, if it's eligible, why not? We saw what happened with Tesla once it got included in the S&P 500, and all this hoopla started around Palantir. But wait, I have to pump the brakes here. Wait. It's not going to $1 trillion next year. It's not going to go to 500 per share in the next 2 years. It's not going to happen, but there's a way. Trust me, stay patient with me. I'll take you for this journey. Now, we can talk all day about the products, Gotham, Foundry, Apollo, and others. But it doesn't matter. There's no need for us to discuss exactly how their products work. What we can take a look at here is 3 things. They make $2 billion a year. Their clients, their top 20 clients, pay $50 million a year, and their net dollar retention is 111%, which means their client pay 11% more than they did last year on average. Now, if those platforms did not work, do you think that people would have paid $50 million a year a pop over something that doesn't work? You know the answer to that. So the products work. And if you want to learn more about how they work, comment below. I'll make a video showing you their application with Airbus, which is absolutely incredible to look at, but we can do it in a different video. The problem right now with Palantir is that the risk-reward system for the stock changed. Palantir at $7 is not Palantir at $14. It's a completely different risk profile, and it freaks a lot of you out, rightfully so. If you've been dollar cost averaging since $7, you're sitting pretty, no problem. You're not freaking out right now. Basically, you're just saying to yourself, well, if it goes down, I'll buy more. If it goes up, I'm just going to watch it go up, right? No problem, no problemo. But if you haven't, now you have a much more difficult choice, but there's a solution. The one thing I just want to show you here is that there's a way to do it the right way. If you've been part of our community, and we have a 4,000 member community on our Patreon, patreon.com/Tom Nash. And on our Discord, we mainly talk about Tesla and Palantir, mainly about Palantir. If you've been a part of our community, you would have seen that we're dollar cost averaging into the stock at $7, $8, $9, $10, $11. You would have been a part of this. Now, that's not to say we hit every single stock right. God knows that's not the case. We make mistakes. But we teach the system, we teach the process of dollar cost averaging long-term into great companies. And we teach you how to do it the right way. We're not giving you fish, we're teaching you how to go out and get your own fish. Now, it's $5 per month, the price of a freaking cup of coffee. Try it out for a month, see if it's worth, see if it's giving you the education you need. And you know what? If you're unhappy with my Palantir, my Tesla, all of my newsletters, everything, if you're not happy with my Patreon membership, I'll refund you, even if you stayed the whole 29 days and you're asking for the refund on the 30th day, I'm still going to refund you. No problem at all. Now, here's the thing. Let's start with the latest financials of Palantir. It's going to be a long lesson, boys and girls. Brace for impact. So on the latest financials of Palantir, we see a few things. Obviously, we saw the second consecutive quarter of GAAP profitability, which was phenomenal. We saw the company on pace to make over $2 billion because they did $520 million quarterly in revenues. We saw 18% year-over-year growth. We saw the US commercial revenue go up above $100 million for the first time in history. We saw 111% net dollar retention, which was better once, but look at the macro. In this macro, 111 is amazing. Mainly, we saw stock-based compensation drop in the past 2 years from $1.2 billion to $400 million. So the stock-based compensation is a thing that's super sensitive to our investors. I get it, but check this out. From 1.2 billion to 400 million, that's not even the most impressive part. The most impressive part is that the percentage of stock-based compensation from the entire revenues of the company went down from 100+% just 2 years ago to 26%. So stock-based compensation is not just going down, it's becoming a smaller and smaller piece from the entire revenues of the company. And I get it. I know why people freaked out. But look, Palantir went from 2,400 employees to 4,000 employees within 18 months. You cannot increase your employment and your HR from 2,400 to 4,000 without giving massive amounts of stock-based compensation. It's just a price of growth. But now it's obviously slowing down. Now, as far as the balance sheet of this company, it couldn't have gone better. $3 billion in cash, $1 billion in a credit facility, which they haven't tapped into yet, $0 debt, $4 billion in assets, $900 million in liabilities, 4-to-1 ratio of assets to liabilities. This company has one of the cleanest balance sheets we've ever seen, but that's not new. Let's talk about scalability, where I think there's a lot of bears are hiding in this category, scalability. Originally, a few years ago, people were saying, well, Tom, this is a consultancy. This is not a SaaS business. Well, mother lover, how is a consultancy deriving 80% gross profit? Can you explain to me? There's no consultancy on this God-given earth, and even McKinsey included, that gives you 80% gross profit. It just doesn't happen. So that was an asinine argument. Now the new argument is, well, it's not scalable. Too little clients. Sure. Let's take a look at it. In Q1 21, just 2 years ago, the company had 60 commercial clients. Currently, it has today 280 clients. 400% increase in commercial client count in 2 years. Show me another company that increases its amount of clients in 2 years by 400%. 60 to 280. Wait. Look at the scale. This ain't some low-ticket item. This is not Snowflake. And I like Snowflake, but I'm saying this is a completely different business. This is a high-ticket item. Top 20 clients pay $50 million a year. 64 new deals of 1 million or more. 22 deals of 5 million more. 8 deals of 10 million more. All of this just happened in the latest quarter, in one quarter. So this is a high ticket item with 111% net dollar retention. And it's growing at 400% in 2 years as far as client count. So don't tell me stories about scalability. Now, the other part, the other fable I keep hearing about is the slowing growth of Palantir. And, it's not growing as fast as 2020, but the macro have changed. Look at the market. Everybody's laying off people. The market ain't the same. But look at this. In the past 2 years, when Palantir is so horrible, in the past 2 years, the revenues went up by 55%. There have been positive free cash flow for 8 consecutive quarters. They did $2.2 billion in 2023 in revenues. And in 2018, just 5 years ago, they did 600. So from 600 million to 2.2 billion in 5 years. In this economy, in COVID, with the war in Ukraine, with all the stuff. Show me a company that does better, except perhaps a Tesla. Now, can it correct? Yes, and it will likely correct. I'm quite positive of that. This is not a trade for me. This is a long-term investment. Now, how do I play this without adding all this extra risk? If I go out right now, if I'm you and I missed the boat and I haven't been dollar cost averaging, by the way, if you want a dollar cost average, if you want to learn the system, if you learn, I'm going to say it again because it's important. If you want to learn the process the right way so you don't get slammed out of a deal like this, patreon.com/Tom Nash. Come with us, learn the system. $5 per month. It's worth it. Trust me. Now, what do you do if you missed it? And now you're looking at a $14 price to start buying Palantir. Well, you're not blowing your load all at the same time, hoping you basically catch it before it goes to 500. You're not buying everything right now at $14. No. Palantir has more work to be done. It ain't going to $500 tomorrow. Relax. You have at least 2 to 3 years to buy into Palantir slowly. Dollar cost averaging every month, slowly, time over time. Wait for red days, buy a little. Wait for another red day, buy a little bit more. Dollar cost average over the next 36, 48 months. Do it slowly. It ain't going to run away in that time. Believe me, there's a lot of time here. Now, there's a lot of work to be done for Palantir. They have to improve margins, which are not there yet. They have to improve their client concentration, even though they've been growing nicely. Their top 20 clients are basically responsible for 50% of the profit. It's just too high. There's a lot of work here to be done. And what I would think here for me is very simple. If you're already in Palantir and you have a reasonable cost basis here, so you're looking at this right now and trying to figure out, well, should I take some profits or not? For me, it's very simple. I'm looking at this and I'm saying, well, look, if it goes down lower, I'll buy more. No problem. If it goes up higher and it flies out the handle and I'm wrong about this and it's going to go to $60, I'm just going to enjoy the ride. Still going to stay in. I'm going to enjoy it, watching it fly. But if you're new to this, still, the risk of it going back down to $7, $8, $9 is just too big for you to lump sum right now into a $14 cost basis. Buy it slowly over time, manage your risk. Now, the good news here is that, look, I think that the AI-driven Foundry and Apollo will be as revolutionary for the US commercial industry as Microsoft was just in the 90s. I think this thing is a game changer. It's going to change the industry. This is going to be the next Microsoft, in my opinion. But the good news for you, the new investors, is that there's plenty of time to do this. This isn't going to happen tomorrow. It's going to take years, which means you have plenty of time to do it. If you want to learn the right way to do it, I'm going to say it again for the 15th time. Go to our Patreon, patreon.com/Tom Nash. Sign up right now so you can learn with us how to do it. You can analyze it. You can look at the good stuff, the bad stuff. Learn the process. As always, it's been a pleasure to spend these few minutes with you. I love you all. See you next video.